welcome to the deep dive. Today, we're going to tackle something you've probably seen on your credit report. Inquiries.
Right, those little notations.
Exactly. And we're drawing on info from, the major credit bureaus, consumer finance sites, that sort of thing. We want to clear up the confusion between soft and hard inquiries.
Yeah, it's a common point of confusion.
Our goal really is just to demystify these checks so you can feel confident about your financial moves and, understand how they actually affect your score.
Absolutely, because you do see that word inquiries pop up, and it's not immediately clear what they all mean. Not every check is created equal, basically.
Okay, let's break it down then. What exactly is a credit inquiry? Like, in plain English?
Fundamentally, it's just a record, a log, you could say, showing that someone looked at your credit file. It notes who checked and when.
Gotcha, a log entry. But, like you said, they're not all the same. Soft versus hard. Let's start with soft, the friendly ones. When do those happen?
Soft inquiries, yeah. Good way to put it. They happen mostly when you check your own credit. Using a free monitoring service or getting your report directly.
Oh.
That's a soft pull. And crucially, checking your own credit, zero impact on your score. None at all.
Oh, that's good news. So I'm not hurting my score just by keeping tabs on it.
Not a bit. In fact, it's smart. You should check it regularly. Another big source of soft inquiries, those pre-approved credit card offers you get.
The junk mail ones?
Well, yeah. Companies do a sort of broad scan for potential customers, and that shows up as a soft inquiry on their end, not really yours in a way that matters for score. Again, no score impact.
Right.
And sometimes employers or even landlords might use a soft inquiry for background checks, depending on the service they use.
Okay. So soft inquiries are basically invisible to lenders when they're deciding whether to give me credit. They don't factor in.
Pretty much, yeah. They see you're checking, but it doesn't count against you.
All right. So then what about the other kind? The hard inquiries, when do those come into play?
Hard inquiries are different. They happen when you actively apply for new credit. You fill out an application for a credit card, maybe a personal loan, a car loan, or a mortgage.
So when I'm actually asking for money or a line of credit.
Exactly. You're giving that lender explicit permission to pull your full credit history to make a lending decision. That's the trigger.
And this is the one that can ding my score a bit, yeah.
That's the key difference right there. Hard inquiries can lower your credit score, usually just slightly. We're talking maybe a few points for a single inquiry.
Just a few points. Doesn't sound too bad.
Usually not, for one. But the issue is if you have a whole bunch of them close together, lots of hard inquiries in a short time frame can make lenders nervous.
Why is that?
It can signal, that maybe you're in financial difficulty and scrambling for credit, or perhaps taking on too much debt too quickly. That perceived risk can lower your score more significantly, but the impact is generally temporary.
Okay, temporary. How long are we talking?
Typically, the negative effect lessens over a few months, and they usually fall off your report entirely after about 2 years, though they only impact scores for about 1 year.
Got it. So how can people listening manage these hard inquiries smartly? What's the advice?
Well, the big one is just being mindful. Before you apply, ask yourself, do I really need this new card or loan right now? Just limiting applications you don't truly need helps keep the number down.
It makes sense. Don't just apply for everything you see an offer for.
Exactly. But there's an important exception when you're rate shopping, say, for a mortgage or a car loan.
Right. You want the best deal.
Of course. So the credit scoring models, they're smart about this. Multiple inquiries for the same type of like mortgages or auto loans within a specific short period, often like 14 to 45 days, depending on the model.
Yeah.
They usually get treated as just a single inquiry for scoring purposes. The system understands you're comparing offers, not desperately seeking multiple loans.
Oh, thank goodness. That's a relief. So shopping around for my mortgage won't trash my score just because 5 banks pulled my credit in 2 weeks.
Correct, as long as it's for the same type of loan and within that typical shopping window.
Right.
And one last tip. Keep an eye on your credit report.
We keep coming back to that.
It's fundamental. Check it regularly. Look for any hard inquiries you don't recognize.
Yeah.
If you see one that wasn't you, you need to contact the credit bureau and probably the lender listed to dispute it. Could be fraud.
Good point. Okay, so wrapping this up, the main takeaway seems pretty clear. Understand the difference. Soft inquiries, they're like window shopping, no score impact. Hard inquiries, that's when you're actually applying, and they can have a small temporary impact. Knowing that difference helps you manage your credit better.
Absolutely. It just empowers you, gives you more control over your financial health by understanding the consequences of your actions.
So here's something to think about. Next time you check your own credit report, maybe do it soon. With this fresh in your mind, look at the inquiries listed. See if you can tell which were soft, which were hard, and what actions you took that might have led to them. It really connects the dots. Thanks for taking this deep dive with us.
If this podcast helped you, don't forget to like, comment, and subscribe. Your support helps us keep making these videos. Thanks for watching.